Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everyone. Welcome to this Wednesday, February 21st, 2024 edition of Trading Places Live with EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. Another trading day that looks like it could possibly get off to another weak start. I'll give you the key indices or the key ETFs that track the major indices. So the diamonds right now down about 0.2%. We've got spiders down a little bit more than 0.25%. QQQ down about 0.6%, and the IWM down 0.4%. So the recent selling, while it hasn't been huge, we have been moving lower. It seems like that will continue at today's open. This historically does represent a not so great week for the stock market historically. We're also in a presidential election year when the second half of February, early March can be a little bit trying. So got a lot of headwinds there in terms of some seasonal patterns, and we're going to have to battle through that. We've also had pretty good run in the market since the end of October last year. As I mentioned back then, I mention it every year. The best time of the year for the stock market is from the close on October 27th through January 18th. And that goes back 75 years. That's end of story. Best period, without a doubt, hands down, is from October 27th close through the January 18th close. We're now a month removed from that period. We've seen the market still continue to go up. We also know that the first quarter, we tend to see more strength in the first half of the first quarter than we do the second half of the first quarter. And that's particularly true on the NASDAQ 100. So we've got a lot of these seasonal factors that are kicking in. We've also got technical issues. We got negative divergences. We've got sentiment issues. 5-day moving average of the equity-only put-call ratio down in a territory where it's showing a little bit of short-term complacency, and that normally results in a market pullback. So we got a lot of short-term issues and seasonality all coming together. I think that makes the market a little bit riskier here in the very near term, but my long-term forecast remains unchanged. I see the market going higher later this year. I see the market higher in 2025 based on all the factors that I look at that have been guiding me for the last several years. Many of you have followed us, and you know our forecasts have been pretty spot on. I'm a realist. I know that there are times we can be wrong. Maybe 2024 is one of them, but I simply give you what we see. And what I'm seeing is still a very strong market looking forward, but we're going to have to get through periods of chop or even periods of short-term selling. And I think we've got one of those at hand right now. All right, let's take a look at the action from yesterday and jump into what's going on. So we have the Dow Jones Industrial Average down, and I'm not seeing the charts coming up just yet. So I want to make sure you get those charts. There we go. Dow Jones Industrial Average down 64 points yesterday. That was down about 0.2%. S&P 500 down about 30. That was 0.6%. NASDAQ 100 down about 140 points. That was down 0.8%. Mid caps down close to 0.75%. And the big loser yesterday, small caps, down almost 1.4%. But most of it was on the gap. We'll take a look at that chart a little bit closer up in just a little bit. But we've had 2 bad days on the IWM in a row, but both of them really have just been selling at the open. And the rest of the day has been relatively flat. Transports down 165 points, down 1.06%. Closing yesterday at 15,463. Remember that big level of support right around 15,200. Again, we'll look at that chart in just a minute. Moving on to the sectors, technology and discretionary. Those were the 2 areas that took us lower yesterday. Technology down just over 1%, and discretionary down. I don't know if I said up, but technology was down over 1%, and discretionary down almost 1%. Staples, on the other hand, the other side of consumer stocks, Staples up more than 1%. So for the first time in a while, we saw a pretty big flip between discretionary and staples. And that normally coincides with market weakness. Now, if the market goes higher and you see that kind of a flip with staples leading by a wide margin, that could be an indication that we're in maybe a more precarious position in the market. And perhaps the short-term weakness could turn into something longer term. So I'm always much more concerned when staples are outperforming discretionary by a wide margin when the market's going up. If you go back and you look at December 2021, that month right before the cyclical bear market began, consumer staples outperformed consumer discretionary by 10 percentage points in 1 month. And that was when the S&P 500 was still trying to go up to all-time highs. Actually, I think it hit its all-time high at that point on January 3rd. So the market was trying to go up, but meanwhile, underneath the surface, we had all this money rotating away from the aggressive discretionary and into defensive staples. That's not what we're talking about here. Here, we were already seeing the market going down. So this is just normal pullback activity. When you see it happening with a market top and consistently happening leading up to a market top, that's when we've got a little bit more of a longer term signal that we need to be aware of. So I just want to make sure we're clear there, because a lot of folks will hear something I say and they take it, a little bit too literally on, oh, staples are outperforming discretionary. That means bear market. No, that's not what I mean at all. Just want to be clear. It's okay for that to happen in the near term, especially when the market's pulling back. We don't want it to happen when the market's pushing forward to all-time highs consistently. Anyway, moving on to industry groups. The gambling stocks down 25 points to 698. That was 3.5%, back down below the rising 20-day moving average. We still see a pretty good AD line, but watch that 50-day moving average. We've been above it now for over a month, and I'd like to see that 50-day continue to hold. Semiconductors. Wow, what? Underperforming. That's something new. Semiconductors down 2.7%. We've had such a huge run. Don't get down on the semiconductors. They may have some more down days to come, and it's okay. Keep things in perspective. Look at this run. By the way, look at when the run started. Not only on the semiconductors, look at when the run started on the S&P 500. What did I say about the best period of the year? October 27th at the close. The low was on October 27th at the close. Now that turned out to be unbelievably consistent with history. Doesn't normally happen quite like that. That was maybe the bullish period on steroids there. But I mean, if you look, that's when the semiconductor group also took off. We were under 9,000 on that index, and we just hit 14,000. Think about that for a minute. The entire index, the value of the index, was under 9,000. And in literally 3 months, maybe three and a half months, we went up more than 50% in that group. I think it's okay. It fell back 2.7% yesterday. And quite honestly, it would be okay with me if this thing fell 10%. I mean, I wouldn't mind seeing the semis correct. It's just healthier, longer term. If we correct, maybe consolidate for a while. And again, this is the time of the first quarter when it could happen. That probably isn't a very brilliant statement. I guess anytime it could happen. But we do have some short-term signals, cautious signals that line up with a possible pullback right now. Autos were weak yesterday, but that's been nothing new, right? Autos topped back at the end of at the end of December. Saw a really rough January. We tried bouncing, did it for a little while, got back to about maybe this key gap resistance level near 750 or just under 750. And now we're reversing right back down. And yesterday finished back below the 20-day EMA, 714 versus the 20-day EMA, which is around 720. So autos, not a healthy group right now, continuing to roll over, probably going to trade back down close to that 650 level. That's what I would expect. Maybe a double bottom. Then we see if that holds. If that holds and we come back up and clear 750, then I would say the odds are that the coast is clear for autos. But we got a lot of work to do before we get to that point. 10-year Treasury yield. Let's get a quick update. Make sure we got the latest here. Not a whole lot going on. 4.26%. We're down 1 basis point. I had the economic reports up. Never really looked at them. And doesn't really matter because we don't have anything really of significance out today. Other than we got the FOMC minutes coming out at 2 o'clock today. So 2 o'clock this afternoon, we could see interest rates do something funky around 2 o'clock Eastern, and that could have an impact on the market. If you see something kind of look strange around 2 o'clock, market either making a big move one way or the other, up or down, you might want to tune in to a news network somewhere and just see what happened with the FOMC minutes. My guess would be that probably something was shared that spooked the market or maybe gave the market a little bit of relief. But I wouldn't view too much of what happens at 2 o'clock in terms of maybe what is likely to happen over the next week to 3 weeks. I still think the market's going to struggle. I think it could just be choppy, maybe sideways, and I wouldn't rule out maybe a bit more selling. I think the S&P 500 down to even 4,800, maybe a stretch would be 4,700. I think it's possible between now and the middle of March for us to see that level. And if we move on, take a look at the S&P 500, you'll see the 4,800 level is really just about the 50-day moving average. But the reason I like 4,800 as support is because 4,800 was our resistance. Remember, we didn't have a candle body, which means an open or a close on the S&P 500 above 47.95 until beginning of this year, when we basically made this breakout really about a month ago, getting up to that 48.50 level. So mid-January was when we finally cleared that 4,800 level. And it's not just this double top here. If you go back to the late January or the early January 2022 high, which I will pull up here. Actually, let's just look at a weekly chart. You can see right here that the highest intraday or the highest daily open or close back then, I'm pretty sure it was 47.95. And you can see when we got up here at the end of the year, we went up to this 47.90 area, pulled back, and then finally mid-January, we made the breakout. So 4,800 is just like a normal pullback to test the breakout level, which we haven't tested yet. So technically, that's like, TA 101. Broken resistance becomes support. That's usually almost a guaranteed test at some point. So 4,800 to me would just be a normal sell-off that, quite honestly, this rally could use. We could use a little pullback, reset, excuse me, reset the RSI lower. I mean, you can see the weekly RSI right now is over 70. We go back to the daily chart. I can add the RSI. We were over 70. Now we're starting to pull back down to about 58, which is nice. Actually, an RSI between 40 and 50 is normally a great time to enter during uptrends. So I do think if we get back to that 4,800 level, we're probably going to see an RSI that dips back into the 40s, maybe all the way down to 40. So, I personally would welcome it with open arms. I mean, I think we've gone too far, and I do think it would be much healthier for the market if we see some selling. And then we'll evaluate the selling. We'll evaluate the various ratios that I like to follow. We'll take a look, see if the CPCE, the equity only put call ratio, see if that starts to build again. Folks starting to get more bearish because the market rolls over. And then it's just rinse and repeat. Market gets too bearish, we get too oversold or back down to a key support level. And then the market's ready to resume its move back to the upside, in my opinion, of course. NASDAQ 100, you can see here still slight negative divergence with these highs. Same thing with the S&P 500. I didn't point it out there. But a lot of times with that, we see a 50-day test. You can see recent lows on the NASDAQ 100 close to 17,000, that is. 50-day moving average, 17,042. Just a typical move back to a key moving average. I think it would be a good thing for the market. Small caps, look at these 2 down days. And now we're looking to gap down another 0.4% or whatever it was. We'll see where we actually gap down. But 2 straight days of gapping down. Look at all these hollow candles. This means we're buying intraday. I mean, if you go back to basically the beginning of February, we've had almost all hollow candles. And even we've had this one, I would say this is the only day, and this was when the January CPI came out. We had the big gap down and we saw a little bit more selling that day. That's been basically it in February for small caps. So I'm not ready to declare small caps, a major victor here, but I do think under the surface, things are still continuing to improve on the small caps. We're in a what looks to me like a cup and handle, or cup with handle. Here's your uptrend. You can't have a cup with handle or any other type of continuation pattern unless you have a prior trend, in this case, an uptrend. So here's your uptrend. Here looks to me like almost a perfect symmetrical cup. Let me annotate this if you're having any problems visualizing this. What you look for, first of all, is an uptrend. I think that's pretty clear, right? And then we want to see some sort of a continuation pattern. We don't know what it's going to be. It could be a bullish wedge. It could be an ascending triangle. And that's not actually, we can't rule out an ascending triangle here. But let me show you the first pattern, which I think is pretty obvious. And that would be this cup. So, I mean, just think about what a cup looks like. I mean, this is a cup. So you go through an uptrend, you pull back, you establish some fear, then you come rallying back up, you test that prior high, and then you put the handle in. It's going to be hard to pick up that cup right there unless you pick it up from the bottom. Need a handle. So handle on the side of the cup comes down. A lot of times the 20-day moving average is a frequent spot for the handle to go. We could be there maybe this morning at the open or maybe early in the trading day. Is that going to be the bottom? I don't know. Possible. But let me show you another pattern after an uptrend. This one's a little different pattern. This is where you have equal highs and you have rising lows. Now, this low right here is really not that significant because in a ascending triangle pattern, what you have is A, B, C doesn't happen until you get the test of the high. So this high right here, it doesn't matter. So this is A, this is B, this is C. This coming down needs to form that channel line. So maybe we go back down and retest that low from when the January CPI was out. That would effectively give us this continuing uptrend line, which could be point D. And then E would be moving back up and breaking out. And the first initial measurement would be the top of this triangle to the bottom of the triangle. That is also the pattern in a cup with handle. Or that's also the measurement, I should say, with that cup with handle pattern. It's the top of the cup down to the bottom of the cup. Here, top of the triangle to the bottom of the triangle. Both cases, we're looking at about 187.5, 188. Let's just say 188, 205 high, 17. You break out above 205 and your initial target's 222. You add that 17 onto the breakout level. That doesn't mean that's all the pattern will go, but that's your initial measurement. That's your initial target if we were to break out of either one or both of these patterns. And for me, that's the best. That's the reason why I like patterns, because it gives me targets. It can give me an area where I might want to set my sell if I'm in the IWM, or if I'm in anything that looks like this, that has this kind of a pattern. It gives me an idea where I might want to put my order. If I want to put my order, it's also maybe I might want to put a price alert in just under that price so that Stock Charts tells me, hey, price just hit this. And then the bell can go off that, hey, that's right, got this pattern, time to maybe sell, and can go in either sell at market or put in a limit order at that point, or maybe put in a trailing stop. Now that, it's made that breakout and it's made its measurement, maybe at that point you want to leave a trailing stop, let that thing run. Lots of different strategies there. All right, transports. Transports, you can see, went up basically double top there at the 16.2 area. And it seems now at this point to be coming back down to the 15.2 area. That's what it looks like. I mean, maybe got a little bit of support here at 15.4, but it doesn't look like to me the selling is ended in the overall market. So I think we got to at least think that we're probably going to go back down to this 15.2 area. And I don't like keep, continuing to go back down there. If you keep going down and hitting support enough, eventually it could break. So 15.2 is important support, but I'd really like to see transports. Like if we do get down there this time, I'd like to see this one be the final one. There's no need to keep going back down to this level, especially if the market does resume its uptrend after a little bit of selling here. All right, moving on. So I want to talk about a couple things here before I get into the trade of the chart of the day. Yesterday we had our top 20, or excuse me, our top 10. Actually, it's almost the top 30, but it was our top 10 stock picks, which is our top 10 stocks going into each of our portfolios. With that, because it was a pretty big webinar, we have a lot of new members. Anytime we have one of these types of webinars, we always have a webinar special. So this is extended to anyone. It could be it could be current members that have maybe their membership expiring over the next month or two. Take advantage, take an extra month, and get 13 months for the price of 12. But here you can see, here's the webinar special. Get the annual. Buy the annual, you get 1 month free. And rather than become a trial member and then go into the monthly membership, listen, if that's what you want to do to try it out for a little period of time, that's fine. But I can tell you that once you go into a monthly membership, you're going to pay $147 a month. And if you get the annual, and especially now with this special, get the extra month for free, you get 13 months for $9.97, not $19.97, but you get 13 months for $9.97. You do the math, and you save almost half off on monthly membership. So, we definitely reward anyone who's willing to take a little bit of risk with us for a year, or in this case, 13 months. We're going to give you the lowest price possible. So just be aware that is out there right now. We do have that available. Also, if you would like just simply to try out our free EarningsBeats Digest newsletter, I always like to point that out. Just scroll down right there. All that one takes is a name and email address, no credit card. You can unsubscribe at any time. That's always a great deal. And trust me, we've had tens of thousands of folks subscribe to our EarningsBeats Digest. So it's very, very popular. And I think it provides value at no cost. So why wouldn't it be popular? And it teaches a lot of things that we look at EarningsBeats along the way. So we have a lot of folks that go in, become EarningsBeats Digest subscribers free for a period of time, maybe a month, maybe 6 months, maybe 3 years. And then at some point, they decide, okay, I want to try the service. But this is a really good way to get to know us, along with these shows, my free articles over at Stock Charts. We try to do a lot for the entire community. And then, of course, we save our best for our EarningsBeats members. All right, I want to show you the chart of the day. So this is one that I just featured this morning. So if you are on the EarningsBeats Digest, if you're on that as a subscriber, then you will have already received probably, or just about received, the chart here. So Trade Desk came out, had a good report. They raised guidance. Everything looked good on the chart. Actually, let's annotate this. So there was that double top that we saw from back in the summer last year before we went into that little bit of correction that we had. Look at the gap up. We gapped up below resistance. I always like, when you're having a gap up, Do you open above or below that key resistance level right there? In this case, we opened below it. So most of the time when that happens, and I have not done a formal study, I can't give you a percentage. I can only tell you based on experience and just based on what I've seen over the years. I believe that that gives us a little bit of a clue that the stock is not ready for a breakout. When it doesn't clear short-term or intermediate term resistance on the at the opening bell, I think a lot of times that is a little bit of a warning. So the intraday move went up above it, but we were in breakout territory and we failed. When you gap up, open below resistance, intraday go up above resistance, and then leave that long tail to the upside, to me, that just looks like market makers trying to encourage buyers so that they can sell shares, maybe for institutional clients. The best way, their market makers' responsibility to institutional clients is to get them the best price possible. They're trying to execute at the best price they can for their institutional clients, even if it's, even if it hurts you and me. If it's at our expense, so be it. They're trying to get the best price they can get for their institutional clients. And so these false breakouts, a lot of times, are awesome because while everyone's buying the breakout, market makers can just sit there and just sell, and get it, distribute a lot of the shares that they in turn will then allow their institutional clients to sell. So anyway, that's how they get them out. But look what happened yesterday, the day after that false breakout. Another big day of selling. Very typical. Again, anytime you see a false breakout, you can a lot of times expect some selling. And so this is a chart that, long-term looks really good. And I'll show you that in just a minute. But now this brings into gap support, which is just below 76, and the rising 20-day moving average, which currently is at 73.5. Those are the two levels that I would be looking at. We still potentially have more room to the downside. I expect we'll see some chop with downside bias. That's what I would expect. I would not be interested in trade desk to the upside to buy it unless we get that breakout at some point. In the meanwhile, I'd have patience. And if you wanted to get into trade desk because of that great report that they just had or because they raised guidance, wait for this pullback, see if you can get a little bit closer to that 20-day or maybe gap support. Our tagline at EarningsBeats.com is better timing, better trades. And I mean, we live by it. In this case, the timing, in my opinion, would be much better if we get that pullback to gap support. Maybe even a two-part entry, gap support and then the 20-day moving average. I mean, maybe you don't like it at all, which is fine. Maybe you want to go see if we hit support at 61, 62. There are a lot of different ways to trade. But the failure of that breakout brings into question the short-term move to the upside. That's all that tells me. All right, let's see. We've got a couple more minutes to go. I do want to mention again, if anybody hasn't seen this chart, this is my 5-day equity-only put-call ratio. Short-term, this is like should be in the trader's handbook, first chapter, because when we get too complacent and these put call readings get too low for a 5-day period and they start reaching into this area, that usually marks a short-term top in the market. I'm not saying this is the beginning of another bear market. You can look back. These readings here, look at this. We had just maybe a 1.5%, 2% pullback, and then we were right back up again. Over here, sometimes this one triggered a little bit more of a downtrend. There were other factors as well, though. It wasn't just this particular signal. This signal, I call it my speedboat sentiment indicator because literally it's just a quick reversal is what I'm looking for, as opposed to like an ocean liner, which, takes a long time to turn around. Speedboat can be like that. We're going down, or in this case, we're going up, too complacent, we get a quick pullback. And we might be in the midst of it right now. And then you'll see folks start to buy more puts as the market pulls back. And this ratio will start, for this 5-day moving average, will start to move back up again. And if we get too far, let's say we go to 4,800 on the S&P 500, you might see us move back up into this 0.75 to 0.8 area, or maybe even slightly higher. That could coincide with maybe a 47 or 4,800 level on the S&P 500. Trust me, things will pick up on the bearish side if we get down to those levels. You'll have clickbait headlines everywhere. The next Armageddon will be setting up. Just wait. But watch this chart. This is a really important chart for a trader. All right. So speaking of raised guidance, I just talked about that. I want to just point this out because this is one of our most powerful chart lists that we put together at EarningsBeats. This is one of the things that we offer to our members. All of the research we do, we try to organize in chart lists. The raised guidance chart list right now, if we do an edit, has 350 companies that have raised guidance basically over the last 3 months or so. So we already know companies that beat earnings, right? They're in our strong earnings chart list, the ones that beat revenues and beat earnings in the last quarter. And now this chart list tells us which companies have raised guidance. So I'll just end with this. This is one scan you can run if you're an EarningsBeats member. Let me go down here, new scan. All of our chart lists are already vetted for volume and liquidity, so we can just get rid of that. But if you go down and choose two chart lists, and I'm going to pull up the strong earnings that was just updated through last Friday. And then I'm going to pull up raised guidance, which also was updated through last Friday. And all you're going to do is run a scan to see what stocks beat revenues, beat earnings per share, and also raised guidance. One click, run scan. I got 116 companies that did all three of those things. Beat revenue, beat earnings, raised guidance, and also looked pretty good technically at the time that they were added to these chart lists. Doesn't mean they always look good because they stay on there until they get ready to report their next earnings, and then they get removed from those chart lists, and they only get back on again if they, again, beat top line, beat bottom line, or in the case of raised guidance, they have to show that they've raised guidance again to get back on those chart lists. But you can then take this list and then sort it by scooter and look at all these companies that are at the top here with very, very strong scooter scores. This is a great list to be working off of if you're a trader. I mean, they're the best stocks out there technically, and they're the best stocks out there fundamentally. What more could you ask for? And we actually have another chart list, which we call our bullish trifecta chart list, which means companies have to be not only on our strong earnings chart list and not only on our raised guidance chart list, but they also have to be on our strong AD chart list, which is our strong accumulation distribution. They got to have strong AD lines. That is the bullish trifecta. And right now, I think there's only like maybe 30 something, 36 maybe stocks on that list that have all of those components. Talk about a powerful list. That is definitely one. Anyway, that is it for me. Let's take a quick look, see what the market's doing. And we are down again. Dow Jones down about 0.4%. S&P down 1/3 of 1%. NASDAQ or NASDAQ 100 down here down 0.6%. We got small caps down about 0.5%. We got the VIX back up over 16, maybe making another run for 17, 18. Possibly, if we go down to 4,800, maybe we'll even see the VIX get to 20. That would be an outlier for me, but it's certainly possible. And so that's basically what we're waiting for. That's why we have patience. By the way, last night when we picked our top 10 stocks for each of our portfolios, we're not getting into them yet because historically, this is not a good week. I think the market, a lot of the technicals are lining up for possible weakness. So to me, it just makes sense to wait until the end of the week to consider moving into the stocks that we selected yesterday. And it's probably going to be a good thing because the number of them that we did select are down. I saw in pre-market day down pretty considerably. So we're going to wait. We'll enter them on Friday. We'll be talking about that more through our daily market report later this week. So please stay tuned to that. And of course, later today, NVIDIA reports. NVIDIA reports, that's going to be a big one. And one more thing, if you do sign up, 30-day trial for EarningsBeats right now, in 25 minutes, we'll have our next live trading room. We hold this for our members, including our trial members. It starts at 10 a.m. Normally, it's supposed to run about 45 minutes. I usually go over, but we'll see. My voice is kind of struggling already. So we'll probably try to keep it to 45 minutes today. But 10 o'clock, it starts. So make sure you take out that 30-day trial. Check out our top 10 stock picks. The video, the recording is out. And also come on in and listen in on the live trading room. Anyway, have a great day, everybody. Happy trading. See you tomorrow on the next Trading Places Live. See ya.